The March meetings, the ECB and the Fed, were quite boring in terms of the outcome on the interest rate decisions. And they also confirmed that both central banks will make their future rate decision based on data. And in that respect, they need more data to show that inflation is really on its way down towards the aimed target of the central banks, meaning 2%. They need more data to show this, and therefore April rate cuts are off the table. And now everyone is focusing on the meetings in June. In terms of the Fed, we join the market view that the first rate cut is likely to happen, and that would leave plenty of time before the US elections. The reason for that is that we expect a slowdown in the US economy to take place, and that will reduce the inflationary pressure, so leaving the room for the first rate cut in the cycle. When it comes to the ECB, we are more skeptical that the data really pave the way for the first rate cut. In our view, wage and underlying price pressure is likely to stay elevated, and therefore it will be too early to act. So if the ECB really means that they act on the numbers rather than acting on the calendar, they probably have to wait. In March, we had two further rate decisions. One from the Swiss National Bank, which, based on very low inflation data, cut rates for the first time of this cycle among the large central banks. And on the other hand, we had the Bank of Japan that also, based on data, went through with the first interest rate hikes for 17 years and now has the main refinancing rate above zero. Looking forward, we think that not just the SNB, but also all the other central banks will make their rate decision based on data, meaning the actual data and the outlook for data, and therefore it is not a clear path. So if there are hiccups showing that the slowdown in inflation is more problematic, we will have pauses in the path of cutting rates. And therefore we do not see the reverse pattern of that what happened in the spring of 2022 when the rates went up. We this time have a more gradual and data-dependent path down from the interest rate peak. The data are not only important for the markets because they have an influence on the rate decisions of the central banks, they also have an impact on their own. And that's particularly true for equity markets. In the US, now the markets do not expect any form of landing. But as I said, we expect a slowdown in economic activity at the end of the first half of 2024. And therefore, that would be a negative surprise, and we think that there is a consolidation in the very overstretched equity markets likely to happen. On the other hand, there is another asset class that is likely to continue its rally. That's the crypto market, and there the 20th of April is likely to be important because that's the day where the next Bitcoin halving is taking place.